Picture this. On August 17, 1998, the world's largest country by landmass, a nuclear superpower with vast oil reserves and a population of 150 million, simply stopped paying its debts. In a single day, Russia defaulted on $40 billion in government bonds, devalued its currency by 75%, and triggered a global financial earthquake that reached from Wall Street to São Paulo to Hong Kong. But here's the unsettling truth nobody talks about. Russia's collapse wasn't caused by war, natural disaster, or external invasion. It was caused by the exact same financial engineering that's happening right now in developed markets around the world. Currency pegs, government debt spirals, and speculative capital flows. The same toxic cocktail that destroyed Russia is bubbling beneath the surface of today's global economy. The question isn't whether another 1998-style crash will happen. The question is whether you'll recognize the warning signs when they start flashing. This is Market Shadows, where we expose the hidden mechanisms behind financial catastrophes. And nothing is ever as simple as it looks. Russia's 1998 crash wasn't just a regional crisis. It was a preview of how quickly the modern financial system can unravel. What started as a seemingly local problem in an emerging market became a global contagion that nearly destroyed the world's most sophisticated hedge fund, crashed currencies across 3 continents, and forced the Federal Reserve to orchestrate emergency rescues for Wall Street banks. This isn't ancient history. This is the blueprint for how financial dominoes fall in an interconnected world. The mechanisms that destroyed Russia, currency speculation, debt spirals, and capital flight, are the same forces reshaping global markets today. If you trace the threads of this story from beginning to end, you discover something terrifying. Russia's collapse was entirely predictable to anyone who understood the invisible architecture of international finance. The warning signs were there for years. The mathematical impossibility was obvious. Yet somehow the smartest people in finance walked straight into the trap. To understand how we got to today's fragile global financial system, and why the next crisis might be even more devastating, we need to go back to 1998. We need to understand how a single country's bad decisions can bring down the entire world. In 1991, the Soviet Union collapsed and left behind an economic wasteland. Factories that produced nothing anyone wanted, a currency nobody trusted, a government that had never learned to function without central planning. But instead of rebuilding from the ground up, Russia chose a different path, one that led straight to financial catastrophe. The decision that doomed Russia was made in 1995, when the government decided to peg the ruble to the US dollar. On the surface, this seemed brilliant. A stable currency would attract foreign investment, control inflation, and signal that Russia was a modern, reliable economy. But currency pegs are financial time bombs, and Russia lit the fuse the moment they committed to defending an artificial exchange rate. Here's how the trap works. When you peg your currency to the dollar, you're essentially promising the world that 1 ruble will always equal a specific amount of dollars. But to maintain that promise, you need enough dollar reserves to buy back every ruble that speculators want to sell. If you run out of dollars, the peg breaks, your currency collapses, and everyone who trusted your promise gets destroyed. Russia made this promise despite having a government that was spending twice as much as it collected in taxes. They made this promise while fighting a brutal war in Chechnya. They made this promise while their industrial base was collapsing and capital was fleeing the country. The mathematics were impossible from the beginning. But Western investors and Russian oligarchs didn't care about mathematics. They cared about arbitrage opportunities. Russian government bonds were paying 30–40% interest rates, while US treasuries paid 6%. If the currency peg held, investors could earn massive returns with seemingly no risk. This created what economists call a carry trade, borrowing in low-interest currencies to invest in high-interest currencies. International investors borrowed dollars cheaply and bought ruble-denominated Russian bonds. As long as the peg held, they were guaranteed enormous profits. The inflow of speculative capital seemed to validate Russia's strategy. Foreign investment poured in, the stock market soared, government officials celebrated their economic miracle. But every dollar that flowed into Russian bonds made the ultimate collapse more inevitable. Here's the cruel paradox of currency pegs. Success makes failure certain. The more successful you are at attracting foreign capital, the more foreign capital you need to defend your currency when sentiment shifts. And sentiment always shifts. The first crack appeared in October 1997, when the Asian financial crisis sent shockwaves through emerging markets. Thailand, Indonesia, and South Korea saw their currency pegs collapse in a matter of weeks. International investors suddenly remembered that emerging market debt wasn't risk-free after all. But Russia's leaders doubled down. Instead of abandoning the peg and letting the currency find its natural level, they borrowed more money to defend it. The International Monetary Fund provided $22.6 billion in emergency loans. The World Bank added another $6 billion. The government issued more bonds at even higher interest rates to attract capital. This is the classic pattern of financial suicide, borrowing money to defend an indefensible position. Every loan Russia took to defend the ruble made the eventual collapse more devastating. Every bond they issued at 50% interest rates made their debt burden more unsustainable. Meanwhile, the real economy was disintegrating. Industrial production had fallen 60% since 1991. Agricultural output had collapsed. The government was paying teachers, soldiers, and pensioners with IOUs instead of cash. Outside of Moscow and St. Petersburg, Russia was essentially operating as a barter economy. But financial markets ignored these realities because the currency peg created an illusion of stability. International bond rating agencies gave Russian debt investment grade ratings. Wall Street banks marketed Russian bonds to pension funds and insurance companies. Hedge funds leveraged up to amplify their returns on seemingly risk-free trades. The most dangerous delusion was that Russia was too big to fail. As a nuclear superpower with vast natural resources, surely the international community would never let Russia default. Surely the IMF would provide unlimited support to prevent a catastrophe. Surely rational economic actors wouldn't destroy their own country for short-term political gains. These assumptions ignored a fundamental truth about currency pegs. They create perverse incentives for everyone involved. International speculators profit by attacking weak pegs. Domestic elites profit by moving their wealth offshore before the collapse. Politicians profit by borrowing money they'll never have to repay. By early 1998, the warning signs were impossible to ignore. Oil prices, Russia's primary source of export revenues, had fallen 40% from their peaks. The government's debt-to-GDP ratio was approaching 150%. Interest payments on government bonds were consuming over 40% of tax revenues. Most ominously, capital flight was accelerating. Russian oligarchs who had profited from the investment bubble were quietly moving billions of dollars to offshore accounts. If the people who knew Russia best were betting against Russia, what did that tell international investors? But rather than face reality, Russia's government made one final desperate gamble. In July 1998, they negotiated another $22 billion bailout package from the IMF, promising to implement fiscal reforms and maintain the currency peg. This was the moment when financial suicide became inevitable. Russia was now borrowing money from the international community to pay interest on money they had borrowed from the international community. The debt spiral had become self-reinforcing and mathematically unsustainable. The end came with shocking speed. On August 13, 1998, Russian markets crashed as investors finally recognized the impossible mathematics. Foreign capital that had flowed in over 3 years fled in 3 days. On August 17th, facing a choice between defending the currency and avoiding social collapse, Russia chose survival. They defaulted on $40 billion in government bonds, abandoned the currency peg, and triggered the largest emerging market crisis in modern history. But here's the truly chilling part. Every step of Russia's financial suicide is being repeated today by governments around the world. Currency manipulation, debt spirals, and speculative capital flows aren't relics of the 1990s. They're the foundation of the modern global financial system. The question isn't whether Russia's tragedy will be repeated. The question is which country will be next and whether you'll see it coming. Principle number 3, avoid leverage. Leverage amplifies both gains and losses during normal times, but during crises, leverage kills. Margin calls and forced selling destroy even mathematically correct positions when timing is imperfect. the ultimate protection. The greatest protection during financial crisis isn't any specific asset or strategy. It's understanding how complex systems fail. Those who recognize the warning signs can position defensively. Those who understand the failure mechanics can position profitably. Russia's collapse taught us that mathematical impossibilities eventually become mathematical inevitabilities. The smart money doesn't fight mathematics. They align with it and profit from its eventual assertion over political fantasy. The information advantage. Today's crisis signals are as clear as they were before Russia collapsed. Debt spirals in major economies, currency manipulations that violate economic laws, carry trades that dwarf anything from 1998, asset valuations that assume permanent prosperity. The information is available to anyone willing to see it. The mathematical conclusions are obvious to anyone willing to accept them. The positioning strategies are clear to anyone willing to implement them. The difference between those who survive and those who thrive during the next crisis won't be luck or timing. It will be preparation, patience, and the courage to bet against consensus delusion when mathematical reality becomes too obvious to ignore. History rewards those who learn from previous crises and position accordingly. It punishes those who believe this time is different, despite overwhelming evidence to the contrary. The choice is yours, but the mathematics are not negotiable. The truth is both simple and terrifying. Russia's 1998 collapse wasn't a random black swan event. It was the predictable result of violating mathematical laws that govern all financial systems. Currency pegs backed by insufficient reserves always break. Debt spirals always end in default or devaluation. Artificial constructs always collapse when market forces exceed political willpower. What makes today's situation more dangerous than 1998 isn't that we face different risks, it's that we face the same risks amplified across every major economy simultaneously. The mechanisms that destroyed Russia are now operating at the heart of the global financial system. The warning signs that preceded Russia's collapse are flashing red across developed markets worldwide. The mathematical impossibilities are obvious to anyone willing to see them. Total global debt has reached levels that can never be repaid through productive economic growth. Currency manipulations by major central banks have created carry trades that dwarf anything from 1998. Asset valuations assume permanent prosperity despite unprecedented monetary experimentation and fiscal irresponsibility. But here's the empowering truth. Every crisis creates winners and losers, and the difference between them isn't luck, it's preparation. Those who understood the mathematics of Russia's collapse made fortunes by positioning against artificial constructs and for mathematical inevitabilities. Those same principles apply with even greater force today. The smart money isn't trying to predict exact timing, they're positioning for certain outcomes. They're building cash reserves for the deleveraging that must come. They're buying crisis hedges while they're still cheap. They're shorting artificial constructs that mathematics makes unsustainable. They're preparing for the correlation breakdowns and volatility explosions that define major financial crises. Most importantly, they're respecting the power of mathematical reality over political fantasy. They understand that central banks are not omnipotent, that governments cannot suspend economic laws indefinitely, and that markets eventually force recognition of unsustainable imbalances. The next crisis won't be caused by war, pandemic, or natural disaster. It will be caused by the same mathematical impossibilities that destroyed Russia. The difference is that this time, the impossibilities exist at the center of the global financial system rather than its periphery. When the crisis comes, remember that Russia taught us everything we need to know about how modern financial systems fail. The mechanisms are predictable, the transmission is instantaneous, and the mathematics are non-negotiable. History doesn't repeat, but if you ignore its lessons about mathematical reality, it will crush you with devastating precision. The warning signs are there. The mathematics are clear, the positioning strategies are obvious. The only question is whether you'll prepare for mathematical inevitability or hope that this time is different. If this gave you a new perspective on how financial crises spread and compound, hit subscribe. History has all the answers about mathematical reality. I'll show you where to look. While most of the world was shocked by Russia's collapse, a small group of investors made fortunes by betting against the very system that was making everyone else rich. They understood something that Nobel Prize winners and government officials missed. Mathematics always wins, no matter how many people believe otherwise. The hidden truth about Russia's crisis is that it was entirely predictable to anyone who understood the invisible scaffolding of international finance. The warning signs weren't subtle. They were screaming for years. But most people don't know how to read the signals that matter. Here's what the smart money saw, and why those same signals are flashing red across global markets today. Signal number 1, the impossible trinity. Every first-year economics student learns about the impossible trinity, the idea that no country can simultaneously have a fixed exchange rate, independent monetary policy, and free capital flows. You can have any two, but never all three. Russia chose all three, which made collapse mathematically certain. They pegged their currency to the dollar, fixed exchange rate. They needed to set interest rates to combat inflation and recession, independent monetary policy. They welcomed foreign investment and allowed capital to flow freely, free capital flows. This combination is like trying to control the temperature, humidity and air pressure in a room while leaving all the windows open. The system will find equilibrium, but it won't be the equilibrium you want. George Soros understood this. In 1992, he made $1 billion by betting against the British pound when the UK tried to maintain an artificial exchange rate. He applied the same logic to Russia in 1998, recognizing that the ruble's peg was unsustainable given Russia's fiscal position. The smart money wasn't smarter than government officials. They just respected mathematical reality, while officials believed they could suspend economic laws through willpower and international support. Signal number 2, the debt-death spiral. By 1997, Russia was borrowing money to pay interest on money they had borrowed to pay interest on previous borrowing. This is the definition of a Ponzi scheme, whether it's run by Bernie Madoff or the Russian government. Here's the mathematical proof that collapse was inevitable. Russia's government debt was growing at 40% per year, while their economy was shrinking at 5% per year. Even if you've never taken an economics class, you can see that this ends badly. But the debt numbers only told part of the story. The real danger was currency composition. Russia was borrowing in dollars and yen, but collecting taxes in rubles. When the currency collapsed, their debt burden multiplied instantly, while their ability to service that debt disappeared. Sophisticated investors like Julian Robertson at Tiger Management recognized this currency mismatch as a fatal flaw. They shorted Russian bonds not because they hated Russia, but because they understood that borrowing in foreign currencies while earning domestic revenues is financial suicide during a crisis. Signal number 3, capital flight acceleration. The clearest signal that collapse was imminent came from watching what Russian insiders were doing with their own money. Starting in late 1997, capital flight from Russia accelerated dramatically. Russian oligarchs who had profited from the privatization of state assets began moving billions of dollars to offshore accounts. Boris Berezovsky, Vladimir Potanin, and other politically connected billionaires were quietly liquidating ruble-denominated assets and buying real estate in London, New York, and Swiss bank accounts. This wasn't random profit-taking. This was informed money fleeing before the collapse. When the people who control a country's political and economic system are betting against their own currency, it tells you everything you need to know about that currency's future. Stanley Druckenmiller at Soros Fund Management paid close attention to these capital flows. He understood that insider behavior is the most reliable predictor of future crises. When those with the best information are running for the exits, you don't ask questions. You follow them. Signal number 4, the yield curve inversion. In healthy economies, long-term government bonds yield more than short-term bonds, creating an upward-sloping yield curve. When yield curves invert, short-term rates higher than long-term rates, it signals that markets expect economic catastrophe. Russia's yield curve inverted violently in early 1998. 3-month government bonds were yielding more than 10-year bonds, indicating that investors believed Russia might not survive 3 months, let alone 10 years. This inversion was mathematical proof that the bond market had lost confidence in Russia's ability to service its debt. But somehow, international credit rating agencies continued to rate Russian debt as investment grade, and pension funds continued buying bonds that the yield curve said were worthless. Signal number 5. The reserves deception. Russia claimed to have $18 billion in foreign currency reserves to defend the ruble. This seemed adequate to market analysts who didn't dig deeper into the numbers. But sophisticated traders like Paul Tudor Jones understood that headline reserves numbers are often misleading. Much of Russia's reserves were actually borrowed from international banks in complex swap arrangements. When push came to shove, those borrowed reserves would disappear faster than they had appeared. The smart money also recognized that $18 billion was laughably inadequate to defend a currency, when international speculators could mobilize hundreds of billions of dollars in a matter of days. Modern currency attacks aren't fought with government reserves. They're fought with market forces that governments can't match. Signal number 6, the correlation trap. Perhaps the most sophisticated insight came from understanding correlation breakdowns during crises. In normal times, different asset classes move somewhat independently, but during crises, correlations spike toward 1.0. Everything falls together. The smart money recognized that most investment strategies in 1998 were based on historical correlations that would disappear during a crisis. Hedge funds like LTCM were betting that Italian and German bonds would converge, that corporate and treasury bonds would trade within normal spreads, that emerging markets would remain uncorrelated with developed markets. These strategies worked perfectly until they didn't work at all. When Russia collapsed, correlations spiked, diversification failed, and mathematically impossible events became inevitable. The information advantage. What separated the winners from the losers wasn't access to secret information. It was the ability to interpret publicly available information correctly. Every signal I've described was visible to anyone willing to look. The difference was that smart money focused on mathematical reality, while everyone else focused on narrative fantasy. Smart money asked, "What does the debt math require?" while everyone else asked, "What do we want to believe?" Smart money understood that markets are complex systems that follow mathematical laws, not political wishes. They respected the power of leverage, the inevitability of mean reversion, and the fragility of artificial constructs like currency pegs. The modern parallel. Every signal that predicted Russia's collapse is flashing red in today's global financial system. Currency manipulation by central banks, debt spirals in developed countries, capital flight from overvalued assets, yield curve inversions, reserve adequacy questions, correlation traps in diversified portfolios. The difference is that today's bubbles are larger, more complex and more interconnected than anything that existed in 1998. When they collapse, the mathematical forces that destroyed Russia will be amplified by algorithmic trading, social media panic, and retail investors who don't understand the risks they're taking. The smart money isn't trying to predict exactly when the next crisis will begin. They're positioning for the mathematical certainties that will play out when it does. They're reducing leverage, increasing cash, shorting overvalued assets, and buying crisis hedges. They're doing exactly what they did before Russia collapsed, and for exactly the same reasons. The signals are there for anyone willing to see them. The question is whether you'll pay attention to mathematical reality or continue believing in narrative fantasy. History suggests that most people will choose fantasy right up until mathematics makes the choice for them. 26 years after Russia's collapse, the global financial system has not learned from history. It has amplified every mistake that caused the 1998 crisis. The same toxic mechanisms that destroyed Russia are now operating on a scale that makes 1998 look like a minor correction. But this time the bubbles aren't confined to emerging markets. They're at the heart of the developed world's financial system. The currency manipulation epidemic in 1998, Russia's currency peg, was an isolated experiment that ended in catastrophe. Today, currency manipulation has become standard practice for major economies worldwide. The European Central Bank has printed $8.8 trillion to keep the euro artificially weak. The Bank of Japan has printed $135 trillion to prevent deflation. The People's Bank of China maintains strict capital controls to manipulate the yuan. Even the Federal Reserve has printed $9 trillion since 2008, fundamentally altering the dollar's relationship to global markets. Every major currency is now artificially manipulated, creating a global system where no exchange rate reflects economic reality. This isn't monetary policy. This is competitive devaluation on a planetary scale. The mathematics are identical to Russia's doomed peg, just distributed across multiple countries simultaneously. Each central bank is promising to maintain artificial currency values that may become impossible to defend when market forces assert themselves. The debt-death spiral goes. Global Russia's government debt reached 150% of GDP before collapse. Today, Japan's debt has reached 260% of GDP. Italy's debt is 145% of GDP. The United States' debt is 130% of GDP and rising by $2 trillion annually. But the real danger isn't government debt, it's the total debt saturation of the global economy. Total global debt has reached $315 trillion, or 333% of global GDP. This includes government debt, corporate debt, and household debt across every major economy. The mechanism that destroyed Russia, borrowing money to pay interest on previous borrowing, has become the foundation of the global financial system. Governments issue bonds to pay interest on previous bonds. Corporations borrow to buy back stock and pay dividends. Households refinance mortgages to fund consumption. The difference between 1998 and today is that there's no safe haven when everyone is running the same Ponzi scheme simultaneously. Carry trades on steroids in 1998. Investors borrowed dollars at 6% to buy Russian bonds yielding 30%. Today they borrow yen at 0% to buy everything. US stocks, European real estate, emerging market debt, cryptocurrencies, commodities, and derivatives they don't understand. The yen carry trade has grown to over $20 trillion, larger than the entire US economy. When this unwinds, it will make Russia's collapse look like a rounding error. But yen carries are just one part of a global carry trade complex that includes Swiss franc borrowing, euro funding markets, and dollar-denominated debt in emerging markets. The interconnections are so complex that no one fully understands how unwinding one carry trade will affect all the others. The LTCM problem. Multiplied in 1998, long-term capital management nearly brought down the global financial system with $1.25 trillion in leveraged positions. Today, the derivatives market has grown to over $600 trillion, nearly 500 times larger than LTCM's peak positions. Exchange-traded funds now allow retail investors to take leveraged positions they don't understand. Algorithmic trading amplifies every price movement. High-frequency trading creates artificial liquidity that disappears during stress. The sophistication has increased, but so has the fragility. Modern markets can crash faster and harder than anything that existed in 1998, because the mechanisms that were manually operated by a few hundred traders are now automated across millions of accounts. Capital flight in real-time Russian capital. Flight in 1998 was measured in billions of dollars moving over months. Today's capital can move trillions of dollars in minutes through electronic trading systems. When the next crisis begins, capital won't just flee, it will evaporate at the speed of light. Algorithmic trading will amplify selling pressure. Social media will spread panic faster than traditional news. Retail investors will get liquidated before they understand what's happening. The infrastructure for instantaneous capital flight has never been more sophisticated or more dangerous. The correlation trap perfected in 1998, correlations between different asset classes spiked to dangerous levels during the crisis. Today, correlations are already elevated during normal times because of central bank interventions. When every central bank is printing money simultaneously, every asset class rises together. Stocks, bonds, real estate, commodities, and cryptocurrencies all move in sync with monetary policy rather than fundamental value. This means that when the next crisis comes, diversification will fail even more spectacularly than it did in 1998. everything will fall together, because everything rose together for artificial reasons. The scale problem. Perhaps most importantly, the scale of today's imbalances dwarfs anything that existed in 1998. Russia represented 2% of global GDP when it collapsed. Today's bubbles exist in markets that represent 70% of global GDP. When China's real estate bubble bursts, and it will, the impact will be 10 times larger than Russia's collapse. When Japan's government debt becomes unsustainable, and it will, the yen-carry trade unwinding will make LTCM look trivial. When the US faces a fiscal crisis, and it will, there's no entity large enough to provide a bailout. The no-exit problem. In 1998, investors could flee Russian assets and hide in US treasuries, German bonds, or Swiss francs. Today, every safe haven currency is being manipulated by its respective central bank. Where do you hide when every government is running unsustainable fiscal policies? Where do you flee when every currency is being artificially manipulated? Where do you find safety when every major economy is dependent on asset price inflation to function? The traditional escape routes have been eliminated by coordinated monetary experimentation. When the crisis comes, there may be nowhere to run. The timing compression. Russia's crisis unfolded over months as information traveled through traditional media and phone calls. Today's crisis will unfold over hours as algorithms react to data. Feeds and social media amplifies panic. The collapse will be faster, harder, and more complete than anything in financial history. Not because the underlying economics are different, but because the transmission mechanisms are instantaneously efficient. The political paralysis. In 1998, the IMF could craft rescue packages for individual countries. Today, when multiple G7 economies face crisis simultaneously, who provides the rescue packages? When every central bank is already printing money, who provides additional liquidity? When every government is running massive deficits, who provides fiscal support? The institutions that managed the 1998 crisis are designed for single-country problems, not synchronized global collapse. The inevitability, Russia's collapse, was inevitable because the mathematics were unsustainable. Today's global financial system faces the same mathematical impossibilities, but amplified across every major economy simultaneously. The mechanisms that caused Russia's crisis, currency manipulation, debt spirals, carry trades, leverage, capital, flight and correlation breakdowns, haven't been eliminated. They've been globalized, automated, and scaled beyond anything imaginable in 1998. The question isn't whether the system will collapse. The question is whether you'll be positioned to survive when mathematical reality finally asserts itself over political fantasy. The warning signs aren't subtle. They're screaming louder than they did before Russia collapsed. The only difference is that this time, there's nowhere to hide when the music stops. When Russia collapsed in 1998, the financial destruction was swift and merciless, but hidden within the carnage were extraordinary opportunities for those who understood the mathematical realities that everyone else ignored. The same patterns that created devastation for the naive created fortunes for the prepared. History provides a clear blueprint for surviving and thriving during global financial catastrophes. The question is whether you'll study that blueprint or join the majority who learned too late that hope is not a strategy. The 1998 winners, what they did differently. George Soros made over $2 billion by shorting the ruble before collapse became inevitable. His insight wasn't mystical, it was mathematical. He recognized that Russia's currency peg required defending against unlimited selling pressure with limited reserves. The outcome was predetermined once the debt spiral accelerated. Soros didn't try to predict the exact timing of collapse. He positioned for the inevitable mathematics and waited for reality to assert itself. When it did, his profits were enormous and immediate. Paul Tudor Jones avoided Russian exposure entirely after recognizing the warning signs in 1997. More importantly, he positioned his funds for the correlation breakdown that would follow Russia's collapse. When panic selling hit global markets, Jones was buying assets at fire sale prices. His key insight was understanding that crises create temporary dislocations between price and value. Patient capital with strong risk management could profit enormously from other people's forced selling. Julian Robertson. Tiger management made billions by shorting weak Asian currencies and buying US treasuries before the contagion spread. Robertson understood that when confidence breaks in one market, capital flows to the safest alternatives available. He positioned for the flight to quality that inevitably follows emerging market crises. When Russian collapse triggered global panic, Robertson's treasury positions soared while everything else crashed. The fundamental principles: these successful investors didn't have secret information or mystical timing abilities. They followed mathematical principles that apply to every financial crisis. Principle number 1: cash is king. During deleveraging, when leverage positions are forced to liquidate, cash becomes the scarcest and most valuable asset. Those holding cash can buy assets from those forced to sell. Those needing cash must sell assets to those willing to buy. The smart money built substantial cash positions before the crisis, not after. They sacrificed potential returns during the bubble to maintain purchasing power when assets became available at discount prices. Principle number 2: short artificial constructs, currency pegs, debt Ponzi schemes, and overvalued asset bubbles are mathematical impossibilities that will eventually collapse. The timing is uncertain, but the outcome is predetermined. Successful investors identified these artificial constructs and bet against them with defined risk and unlimited patience. They didn't need to predict exact timing, they just needed mathematics to eventually matter more than political fantasy. Principle number 3: buy crisis hedges. Before crisis insurance is most valuable when it's least available. The time to buy crisis protection is when everyone believes crisis is impossible, not when crisis becomes obvious. Smart money bought treasury bonds, gold, and volatility protection when these assets were cheap and unloved. When crisis struck, these hedges soared while everything else collapsed. The 2025 playbook. The same principles that created fortunes in 1998 apply with even greater force to today's more dangerous financial landscape. Position number 1: dollar strength. When the global carry trade unwinds, trillions of dollars in borrowed yen, euros, and Swiss francs will need to be repaid in dollars. This will create massive dollar buying pressure that could drive the dollar substantially higher, despite US monetary policy. Unlike 1998, when dollar strength was a side effect of the crisis, today's dollar shortage could become the primary driver of the crisis. Those positioned for dollar strength before the unwinding begins could profit enormously. Position number 2: interest rate. Volatility. Central banks have suppressed interest rate volatility for over a decade through forward guidance and quantitative easing. When their credibility breaks, interest rate volatility will explode as markets rediscover price discovery. Volatility is currently trading near historical lows despite unprecedented monetary experimentation. When the next crisis demonstrates that central banks are not omnipotent, volatility could spike to levels not seen since the 1970s. Position number 3: real assets versus financial assets. The 1998 crisis was primarily a financial crisis that left real assets relatively unaffected. The next crisis will likely involve currency debasement and inflation, making real assets more valuable than financial assets. Productive farmland, energy infrastructure, and commodity resources will maintain value during currency crisis. Financial assets backed by government promises, bonds, bank deposits, pension claims, will lose value as those promises become impossible to keep. Position number 4: geographic arbitrage. In 1998, investors could flee dangerous markets for safer alternatives. Today, when every major economy is running unsustainable policies, safety requires geographic diversification to smaller, more stable economies.